So I'm Coco Chen. I am from the Association for Financial Markets in Europe, representing large sell-side institutions in their adoption of blockchain, both across real-world assets, but also crypto assets as well. Joined by a very distinguished panel here. Maybe we could start with some short introductions from you, Stefan, and working our way backwards.
Hello. So I'm part of BNP Paribas Asset Management, and I'm dealing with all these digital assets projects.
Hi, it's Angus Fletcher. I'm head of digital at State Street, so supporting asset managers in their issuance and custody off the back of that.
Thank you. Good afternoon, everyone. I'm the second French guy on the panel. My name is Paul-Adrien. I'm co-founder and CEO of Spiko. It's a fintech company, mostly based in Paris at the moment, which launched the first UCITS money market funds on public blockchains back in 2024.
Hello, donc David Durouchoux. I'm the third French guy in the panel, and I'm from Société Générale Forge. I'm the deputy CEO in charge of the business relation, and voilà, we've been issuing a stablecoin in 2023 and working with Morpho on many times.
My name is Robert Crossley. I work for Franklin Templeton. My job is really to understand how business models are changing and competitiveness is changing, and blockchain and digital assets is a large part of how all our futures are changing.
Excellent. Well, thank you all for joining us. I can pass these down. So I can't wait for all of you to be talking over each other, and we need more microphones for that. So we hear a lot about tokenized funds and tokenized MMFs. We hear about all the benefits. I think a lot of these have been kind of well covered by previous panels. Programmability, 24/7, mobilization, instantaneity, transparency, accessibility, and maybe even kind of creation of new collateral and secondary markets as well, which we'll come on to shortly. We have a very diverse panel, which is great, and maybe we could kind of turn to some of the buy-side players just for you to tell us like what's really changed in the last, let's say, 6 to 18 months. Has the dial been shifted? I don't know if Stefan or Robert, you want to start?
It's me. The way I look at things is there's, I think, of a distribution of adoption and maturity, and obviously different firms and different institutions and different governments have been at different places, but it's really the direction of travel and the speed of travel. So obviously the change in the political climate in the US has made a massive difference globally, and I think given a lot of firms and projects confidence in the direction of travel. At the same time, from my own experience, I see that whatever the type of firm, their eyes are being opened to the real world benefits and the realization that they've got to engage and understand and apply this to their current business model. And I think there's so much more, I suppose, open-mindedness and willingness to engage, and a realization that this isn't going to go away. There are huge benefits and real corporate life-changing benefits on offer. Which side of that divide that you lie on, the positive or the negative, is going to be determined by your decisions in the next 6 months, in the next year. And I think that realization that this is important and is almost existential for your competitiveness is really what's changed for me.
Oui, donc sorry, pardon. On our side as a bank and stablecoin issuer, we've seen, let's say, the democratization of stablecoin, and we noticed what is very important in the asset management environment in France, the Spiko rise, and congratulations, guys. Because in France, the asset management, except a few people which are probably around this panel, were a bit lagging behind, especially the US. And it's true that the US change in policy has been, let's say, maybe unlocking some, let's say, informal blocking points and in the mindset of of the French asset manager, and they started to look, especially as BlackRock, etc., with different. We see really a change in the way asset managers are considering crypto, including spot crypto, etc. Not only the tokenization of the fund shares, and I think it's very positive. And of course, there is the question of what do we do with those tokenized money market fund shares, and are there true crypto? And I think that's the key point, because if you want to sell it into crypto worlds, they have to get the same way of buy and sell, etc.
Yeah, I think we could come on to the kind of like operational and legal questions in a little bit, but maybe turning to you, Stefan, what kinds of appetite and demand are you seeing, and has that kind of surged in the last couple of months?
Yeah, and maybe to complete what has been said, I think now we see plenty of asset managers issuing tokenized money market funds. I think we have 10 to 20 asset managers issuing this kind of products, and also startups like Spiko. So this is new, and I think in 2021 or 2022 we had only one asset manager issuing tokenized money market fund, and it was Franklin Templeton. So this has changed, and what we see also starting is some interest from clients, from corporate clients, from institutionals. So they are entering this race, and this is also quite new.
So I think from a service provider on our side, I haven't been at State Street that long, but 5 months, but in that time I've probably had about 40 customer meetings, both with asset managers and asset owners during that time. What I think is really interesting is when you break down where those asset managers and asset owners are along this journey, I would say around 80% are still at the end of, they're being asked from their CEO and seniors to say, what is tokenization? Why do I need to care about it? Where should I be moving and acting on this? What the benefits, but also what's the downside if I don't do something? I think then there's probably about 10% that are in the view of going, we know we need to do something and we want to do something, but we don't really know where and what type of tokenized products that we want to put out. And then there's the 10% that are hammering us to say, we need to get something out, in the next 6 months. But I think it's back to Robert's point. There is a massive tail here that is slowly moving towards, I would say, I'd almost put it like experimentation at scale is really where we're going to move into in the next phase.
Yeah, and Paul-Adrien, I think you're one of the companies that is often kind of talked about as moving this product beyond a POC phase. Can you just tell us a little bit about who you're working with and what sorts of values and benefits that you're bringing to this market?
Sure, thank you. So in terms of investors, of users of our products, it's actually quite broad. We have a mix of corporates, institutions, and also retail who are using our platform. Overall, we are talking about thousands of customers, not tens or hundreds of thousands yet, but it's growing fast. And in terms of the, why are they using us and what are we seeing in terms of use cases, I think the first reason is access. Accessing a money market fund is still, interestingly, quite difficult in Europe. I think it's a different picture in the US, but in Europe with the traditional securities account stack, it's not that simple. Number two is transparency, like having access to read access on the shareholder register, whereby you can see the number of users, the movements, the investor concentration is quite interesting. And we are talking with a lot of corporates who are actually super interested in that kind of features because they feel like traditional money market funds are sometimes too black boxy, I would say. And the third pillar is the new use cases that we see emerging. And to your point on what has happened over the past 6 months, it's the emergence of these new use cases. Integrations with DeFi protocols like Morpho, Uniswap, the usage also among corporate organizations to transfer cash between different entities 24/7. That's the sort of use cases that are not anymore at the POC phase, I would say. They are still quite nascent. But we definitely see them among our users. And that's super interesting in my view because it's definitely something that cannot be done with traditional MMF.
Yeah, so I think it definitely kind of sounds like these benefits are well recognized, and we're sort of kind of moving towards a more kind of mature phase for these products. And I think that's also very much kind of evidenced by the fact that we have the big players on board in these markets. And I think just kind of talking about numbers, and AFME does publish a DLT market data report on a biannual basis. I think we're still kind of looking at, obviously, just a very small fraction of tokenized funds compared to traditional funds. I think it grew 400% from 2024 to 2025 to around $11 billion for AUM. That's, of course, a very small fraction of a 140 trillion euro market, roughly. So I think we're still growing, and we're still kind of taking incremental steps. But I think if we kind of think about some of the transformative implications of these funds, are we kind of talking about new products, or are we talking about an expansion of existing products?
Sure. I think it's all of the above. I think there are two separate audiences. There's the those in DeFi who are au fait with blockchains, and then there's where all the money is, obviously in traditional finance. The way that we think about it is there's the infrastructure of the entire industry is being replaced. The infrastructure, or the sort of the operating system, by blockchain, more efficient, et cetera, et cetera. On top of that, you have a payment or liquidity layer. So these are all these different forms of money. So whether it's tokenized deposits, CBDCs, tokenized money market funds, et cetera, that payment layer has to become interoperable in order to then build the products and services on top. Whereas we tend to fast forward straight to the product, because that's what we're all interested in. And so we've been through all these POCs. We've been through this stage where everybody people tokenize a bond issue or tokenize an equity and then wonder why that hasn't magically created liquidity. What's enormously significant, and linking it to your first question, is the DTCC in the US, or the DTC, last year announcing their project to tokenize $100 trillion of US securities, and being able to offer the option of whether you trade on the tokenized rails or you settle on the traditional rails. And so that top-down tokenization choice, I think, will enormously accelerate both the development of products, and because we have a choice of infrastructures that we're going to use, we'll see the displacement of traditional accounts more and more by the users who want the real-world benefits that tokenization offers. It's not that tokenization is magic, or it actually does anything different to the cash flows of the underlying instrument, but it increases the utility enormously of what you can do. And even with something like a humble money market fund, all that is about yield. But if that is natively on-chain, you can pay real-time interest, you can update the shareholder record in real time. This real-time transparency and control is one of the massive benefits of all of our assets, but it doesn't fundamentally change the underlying cash flows.
What we see is that as we are building a bridge between TradFi and DeFi, it's our role as a bank precisely to be there in the middle. And from a cash perspective, it's relatively easy, because you get stable coins, because you get many types of, let's say, tokenized cash, and that's let's say the easy part. The problem we're having at the moment when we want to hybrid for several clients those two worlds is precisely the asset leg. And the asset leg, you have only few asset leg which have the same characteristic in TradFi and in DeFi. And that's why we are focusing on money market funds, because you have this native liquidity, which is a standard in the crypto ecosystem. Let's say it's that's the world of the instantaneity. Donc, of course, if you are squeezed to illiquid asset, it's very complicated for the asset manager to manage, etc. Donc you are taking risk. Bon. Donc that's the first aspect. And the second aspect is all the 24/7 question, which is as well a standard in the tokenized world we spoke about already. And such products are very rare. So we are very happy to see that the number of those products are growing. You obviously you were the first. Spiko is part of that game as well, and we see that the standard now is okay. I want to issue a new type of fund, tokenized, etc. But I want it to be compatible with both worlds, and I think that's the big challenge we are facing at the moment.
And I think that is it sounds like the kind of technical solutions are available, but there's still some teething issues there. Angus, did you want to?
Yeah, I mean, there are definitely, tokenized money market fund makes complete sense. It's collateral mobility. I mean, it potentially is a form of cash, although it's a security, it's a form of cash instrument, and it can become that even more once you tokenize it. I think there are other areas, though, in particular. I mean, ETFs, we're starting to see clients come to us to say they'd like to tokenize ETFs. And then there's a lot of conversation around private markets. And I think that is definitely an area that makes a lot of sense to look at. I don't think tokenizing it necessarily solves the problems in private markets, but I think it puts a degree of focus to resolve standards, to think about how you would actually create secondary markets in it, and what are the needs in order to be able to do that, how you fractionalize, what's your risk management, etc. So, but I think that's going to take a bit longer. But the point about hybrid and traditional, I mean, it's, again, from State Street's point, we recently launched our foundational platform that is, the whole focus on it is about being able to manage both the digital and traditional rails for all types of product, jurisdiction, blockchain agnostic, and to make sure that you can actually manage all the different underlying fund constructs. Because I think we talk about this a lot of just saying, you know, it's a tokenize this, tokenize that. There's digital twins. There's, I mean, just take Luxembourg as an example. There's a registered share model, and then there are two dematerialized models of central account keeper, control agent. You've got three different choices potentially of how you set up, and that changes entirely the way a service offering works off the back of that as well. So it's how you manage all of that that's critical. If you want to get the efficiencies, that has to be managed in an effective way, and we're only going to get more pressure from our customers to bring prices down, or at least to have them par on traditional level, traditional digital. It shouldn't really matter.
Could I just add one thing to what Angus said? There's something really important embedded in that, is that we've been talking about tokenization, and the real important shift is the move that implies this move from accounts to wallets. So wallets will be the single locus of control for our assets, our liabilities, our benefits, all sorts of different things. It's that concentration of control, and also when anything moves on chain, when anything's tokenized, it becomes a piece of software. A wallet is a piece of software, a token is a piece of software. Software is programmable, so assets become programmable. And so when you talk about benefits earlier, I think the implications are the programmability of assets and that shift from siloed accounts to interoperable wallets, and that changes the game for all of us and enables us to add value to clients in completely new ways that was previously impossible.
Could you give some examples of what you'd be able to do for clients with these interoperable wallets?
Well, how long have you got? Where do we start? I think the inefficiencies and frictions that are inherent in our traditional system is a very easy one. BCG has estimated that blockchain will save the industry $20 billion a year just from inefficiency, and free up $100 billion of collateral. So assets that are currently encumbered that aren't being put to productive uses. I think that all the panelists have touched on it earlier, the real-time control and transparency, the ability to be able to, whether it's to cross-collateralize, to be able to use assets so much more efficiently, and to be able for more of the benefits of the ownership of the asset to accrue to the actual owner rather than to the various intermediaries. Because when you think about a whole financial system, traditional finance, what's happened is that institutions have crystallized around processes. If you have access, traditionally if you had access to infrastructure or you ran a certain process, a company appeared around it. On a blockchain, blockchains are really just interoperable process, a platform for interoperable processes. Those financial processes will be so much more, I suppose, composable, interoperable. The end value to clients will go up enormously because everybody sat here will have to deliver more value at lower cost and deliver new forms of value that blockchain allows. But there are lots of others.
I think it's also important to remember that we are talking about a new technical stack to be able to support these assets. You need to be in a capacity to generate wallets, to operate wallets at scale. And this is something completely new for many, many distributors. And what we have seen so far is mostly asset managers building this stack and offering access to the product directly to the end consumers. It's a super interesting development, effectively. But at the end of the day, the distribution, the pure players focused on distribution will be extremely important when it comes to scaling these assets to many customers. And we need some time, for those to be equipped with the relevant stack, effectively.
And are we actually kind of seeing that accessibility increase with tokenized funds? I know that distribution is always kind of talked about as one of the best real economic use cases of tokenization, but is it actually democratizing access for a broader array of investors, or when might we see that if it hasn't happened already?
So what the blockchain brings is a new way to deal with your assets. You are changing the rails. So you need also your clients to be equipped with wallets, etc. So in fact, we need also these clients to be able to manage wallets or to be able to deal with this new technology. So it's an ecosystem play. So at the end, we need all the ecosystem to move into this digital asset space. So that's why it takes also some time.
And just to add to that, I think we tend to think of democratization as democratization of access to an existing product. Really, I would argue that it's really about democratization of access to the benefits that the technology allows. So going back to a simple money market fund, if you're updating the shareholder record in real time, you can pay interest in real time. That is a real benefit that's a direct result of the technology. And so it's not, I would encourage people not so much to think in terms of, is there a new audience for our existing products, but how can we use the technology to create new benefits that are perhaps embedded in the asset, attached to the asset, or in the ways that we move the asset or hold the asset or we can utilize the asset. That's the real democratization. It's not that suddenly everybody will be able to buy private products and everything will be wonderful.
I think that's a really kind of constructive way to think about this. And of course, we've spoken a lot about the benefits, a lot about the values added by tokenizing funds. And of course, I think we're still at a relatively early stage when it comes to widespread adoption. Just looking at this kind of future pathway towards adoption, what are the kind of key criteria that are still needed to be able to kind of really fully realize the benefits we've spoken about?
So we talk about 24/7 an awful lot, 365. I think once we get to a point of scale and greater scale, actually institutions need to really think about what that really means, because we have operating models in all our organizations that set up for 12 by 5 or whatever around that, and that goes all the way through the chain to CSDs, exchanges, etc. And I know there's a move to change for that, but what's the cost associated with having people operating 24/7? There's ways you can set up that business model or that operating model, but it's going to take time. You need to think about where's your escalation channels when something goes wrong, and how is that going to be managed. I have a little thing going forward as well around. I actually disagree with you slightly on what a chain is. I think chain is market infrastructure, and ultimately, we should be, as an industry, pushing blockchain providers to be thinking about the financial market infrastructure principles that IOSCO put out, and actually start to say, how do those blockchains meet that? if there are outages or issues, there has to be an understanding as a set of institutions, I believe, that you know where the problem is and what you're going to do in that particular eventuality. And I don't think we're spending enough time as an industry thinking about that.
I think there are definitely questions around, who to hold accountable and what's the right governance structure, right? Do you kind of retrofit what we already have onto new stacks, or do we kind of reinvent something new for?
And I think that's the point. The earlier we start to address these issues, it becomes less of a retrofit. And I think the chains that start to think in that way are actually put themselves in a far stronger position in terms of growing their network, because it's all a network business ultimately. Yeah.
And that point about resilience is so important. So, for instance, at Franklin Templeton, we run on 10 public chains, use 3 different cloud providers to provide that resilience, because no matter how good your technology, if there is a single point of failure, it really doesn't matter. And I think the other important point swirling around here is who we want to take responsibility for what we're doing and the technology. So do we want to devolve it to a service provider because they're better placed to do it? Do we want to do it ourselves? And I think being forced to ask a different set of questions and what will add the most value to our clients is what this debate is really forcing, not so much what's the next thing I can hit with the tokenization hammer.
I think there are many drivers of adoption, but one which I found quite interesting is the integration between stablecoins, tokenized money effectively, and tokenized funds. At the moment, it is still difficult when you hold stablecoins, for instance, to buy fund shares, tokenized fund shares, mostly because the integrations between the stablecoin issuers and the fund issuers are still a work in progress, I would say. When we have this in place, it unlocks a lot of things. First, access for those holding stablecoins, of course, but also use cases that you can have. Imagine you are settling a subscription with SWIFT, for instance, in foreign currencies because you are abroad or whatever. It takes a lot of time. If you can do it with stablecoins, you can imagine having several cutoffs per day, execution of your subscriptions, redemptions with stablecoins super fast at the cutoffs. All these things will create, to your point, new use cases and will drive adoptions, because when you are a corporate, for instance, you have cash on the Friday evening, you cannot put it in a money market fund, or it will be, you can wire the money, but it will be effectively, the fund shares will be created only on the Monday, and you will lose the interest for the weekends. As soon as you can use money that moves faster, and you have more powerful funds that have several cutoffs per day, this changes the pictures, and you become really interesting for a lot of users.
Having available and adequate cash solutions, basically, to me.
And also, in the future, I think we'll have wholesale CBDCs in several jurisdictions. We'll have stable coins. We'll use also tokenized deposits, deposit tokens, tokenized money market funds for the cash leg. So plenty of possibilities for the cash leg. And then we'll have to use the right digital cash for the right use case and for the right clients. So this is also an important point. And regarding what you said around the backup plans, etc., there are several ways also to tokenize assets. We can either take existing assets and mirror them on chain. We can issue directly native tokens. So yeah, several ways to tokenize assets, several blockchains, several digital cash legs. So yeah, we'll have some work to do.
Yeah, just coming back to something you mentioned, Robert, around kind of operating on 10 different public blockchains. Obviously, that increases resilience, as you mentioned. Does it also increase fragmentation? And what are kind of ways to kind of solve for interoperability if it is? I think it will be needed when the market consolidates.
I think you're absolutely right in that what we're all solving for in different ways is interoperability. And you're right, in terms of the operational burden, that means we have to every single transaction, every single block cycle, we've got to reconcile that across those chains. Now, that sounds like a frightful task if you're still thinking in terms of sort of a traditional mindset. The technology allows that to be, it's not a simple process, but it's something that is perfectly, something that's perfectly possible. And the previous panel, which was sort of excellent, one of the things that they talked about was the danger of thinking in a sort of traditional way or thinking in a almost an outdated way. And I think one of the dangers that we all face as an industry here is that the world is changing and possibilities are opening up faster than we're updating our beliefs about it and updating what we can do. And so what sounds like complexity running on multiple chains is actually a strength, but you have to think in a different way and you have to operate in a different way. There's no point it's like when the internet came along and newspapers just suddenly decided to PDF themselves and put themselves on the internet. You're kind of missing the point. There's a lot that's going on, or there's some that's going on in our industry that is using that sort of misapplied thinking, and so we're not extracting the benefits of the technology.
Absolutely.
On this, I completely agree. I think, interoperability bridges is a technical problem, but to some extent it has already been solved.
Yeah.
So I think it shouldn't be an issue at all.
Well, I would be fearing more the decentralization aspect of the blockchain, because when you have decentralized pool, by construction, you have not really deep liquidity pools. While in the end, if you want tighter spread, more liquidity, etc., you need a very deep pool of liquidity on specific assets. So if you have, let's say, a tokenized money market fund from Franklin Templeton or BNP or whatever, if you have small pools here and there, basically you have inefficiency in price discovery. You have arbitration capabilities where the hedge fund will make a lot of money on, let's say, the traditional and the real economy. And I would fear more that than the multi-protocol. Multi-protocol, you can be multi-protocol, it's a matter of investment. Now there are only a few protocols which are really sound and active, etc. And we can cope with it, it's a matter of investment. But the decentralization in itself, if you are really Web3, that can be a deep problem for the coming. And typically with Morpho, we are working with Morpho. They saw that, and so they are trying now to pool precisely and to reconcile with the decentralized aspect of their own pools, precisely to bring higher liquidity. Because at the bottom, when you have a pool, euro convertible versus BNP or whatever, you have this pool is not against another asset. Donc everything is fragmented. Donc we are rebuilding that, I think.
Could I just respond to David there? I think that's such an important point that we have to think about liquidity differently. So we're used to thinking of liquidity being centralized and having a central a venue, a pool of liquidity. In a distributed, decentralized infrastructure, liquidity doesn't mean something different, but it comes about in different ways. And so having providers who can connect those different sources of liquidity in different ways, the ability to understand in real time what is happening, it fundamentally changes how we think about trading and exchange. And remember, everything is happening in real time here, and we haven't even talked about sort of vaults and automation, etc. In terms of it being it being in the future, so at Franklin, we've been running this money market fund for almost half a decade. There's no more need for POCs. The technology works. The POCs that we need are within our companies and firms understanding the potential and the strategic potential and applying it and finding the right partners to be able to extract the benefit from it rather than trying to go it alone. In traditional finance, we tend to have this zero-sum mentality where we will build it all. We've got to think in a much more sort of DeFi open source way rather than the closed source way.
But I think there is still a lot of that mentality of building, when I look in the DeFi space of digital, it's almost like the Wild West going on at this moment in time. There's new chains being created, new vendors turning up with a new product that is kind of the same as someone else's. There's new incumbent infrastructures that are trying to build almost their own silos as well. And we, as you say, we have to get over this mentality of going, this only works if we're all working together in a certain way. And we need to start to think, how many chains do we really need, for example? What are actually all the functions that you really need for that? or for the business. And yeah, where is your liquidity? Where are your funds being issued, et cetera, and who's your customer base? But there has to be some convergence soon, because the cost of just reviewing half of these things is, let alone connecting, is a massive challenge.
And to Angus's point, when we talked about adoption earlier, one of the things we haven't talked about is the ability to scale is going to depend on acceptance, which is going to depend on the enterprise risk controls. It's no point just having just the technology. It's got to be deployed in a responsible way by a responsible, not responsible actor, but by an institution. And so we've got, as an industry, we've got to figure out how we can marry the technology with the enterprise risk controls, which enable us to scale the usage of it. It's not just about having a better chain or a better widget or a better technology. It's how do we integrate it into our existing processes and our existing regulatory processes, and that's the real challenge.
And education, right? The problem is as you say, you're dealing with a whole set of people that think traditionally, and actually how do we educate them in a way to be thinking in this different way and looking at, there are certain risks they have to manage, like reg risk, op risk, but they have to think about it in a different way, and that's a huge challenge, because we tend to have people who either sit in DeFi world or in traditional world, and it's bringing those two things together that really is what's going to make the difference.
And yeah, David, you mentioned DeFi protocols, etc., but this is maybe for the secondary market. And in order to bring liquidity on the primary market, it would be nice also to have some additional issuers issuing commercial papers, bonds, equities on the primary market and available 24/7. By doing that, we're solving some issues.
Yeah, so primary market volumes still kind of remain a little bit stagnant. So I think we've talked about a lot of kind of different factors that might impact adoption. I think it sounds like there's kind of cultural factors, there's technological factors, there's kind of risk appetite, and questions around how to kind of navigate this slightly new landscape. And I know there's some maybe regulatory issues as well. I know that certainly kind of for banks, there's still kind of some issues when it comes to kind of serving the buy side. David, do you want to kind of comment on issues that you think might be in the way?
Ouais, my favorite topic, prudential approach. Yes, no, the question, and it joined with Stefan a question. How do we, let's say, push forward adoption, etc.? Meaning that are liquidity provider incentivized, let's say, to bring liquidity in the market, to push it to first buyer, etc. And the question with crypto, and especially not the tokenized money market fund, it's more tokenized fund which have crypto on the asset part. So exposition to Bitcoin, ETH, etc. Those, as a bank, we are facing really tremendous limits. The harsher one would be probably the core tier 1 limit for SocGen, for instance. It limits our desk at gross 300 million exposure to crypto total group, which is nothing, obviously. If you take, let's say, a buffer, because there is the volatility, so it's probably lower. And that's really an enormous problem. We have as well the question of the prudential impact on the balance sheet. If you are a full crypto, Bitcoin, etc., in theory, if you are following the Basel rules, it was 100 to 1,250. You know the stuff. And that's being discussed at the moment. But during that discussion phase, inherited from previous Basel discussions, it's at the Basel time frame, quoi. Donc, meaning it's years and years before it gets open. Donc, voilà, we are stuck in that. And unless we have that lifted, it's being a bit complicated for us to animate the market, etc.
So I think we're talking about some kind of real binding constraints here for banks, but hopefully those will be resolved with enough convincing advocacy.
Thanks to afme work.
But I think just a final question for all of you around really kind of what you or your organization envisages as a near end state for fund tokenization. Do you have a vision for what that might look like?
I mean, from our perspective at Spiko, it's every asset coming on chain, being tokenized. We mentioned like there are not funds are being tokenized, but there are not that many like primary assets, like the underlying assets of the funds that are being tokenized at the moment.
Yeah.
So we are still at the very, very, very beginning of this journey. And to your point on regulatory barriers, there are barriers when it comes to listing these products at the moment. There is, especially in Europe, I think, the pilot regime regulation has some merits because it exists, but it's a sandbox environment. There are very strong limits around it. And the outcome of this is that like innovative companies like Spiko typically do not go into that direction because it feels like it would limit our growth pretty quickly. So we stay in the unlisted space, the non-listed space, which is fine, honestly, for now. But if you really want to push this movement, this innovation, I think we should free the listing of these securities. The admission to trade on trading venues of tokenized securities without any limitations. I don't see why there are any limits for this. The outcome of this is just that this is not developing.
Definitely, that's my favorite topic, actually. Trading eligibility.
From my point of view, it's about how you manage digital and digital and traditional. It's going to be, I believe, like this for the foreseeable future. So bringing those two elements together is going to be absolutely critical, whether it be account and wallet management. What does that model really look like, for example, bringing those two together, whether it be a new infrastructure, existing infrastructure. As you say, DTCC, I think, has been really forward-thinking in looking at exactly how that works. And I think we as an industry really need to be able to manage that. And that's certainly a State Street, the way we're really pushing to be able to serve our clients.
And to Angus's point, it's definitely both and rather than either or. And I think the reason for our collective befuddlement, and the question apart from Paul, who reacted more quickly, was that tokenization is a wrapper. A token is a way of getting exposure to the wealth that's being created outside the traditional capital structure of equities and bonds in DeFi. A token is a way to wrap a traditional asset. Tokenization is a way to make traditional assets usable in the DeFi machinery. So tokens can mean all sorts of, have many, many different meanings. And unless we sort of pass those meanings out, it's a really, really difficult thing to describe where our end point is going to be.
When we see coming over some big animals, we've been partnering with Deutsche Börse Group. Deutsche Börse Group has now a strategy for tokenizing all the database and all the assets they have in the CSD. That's a pity, but they are not using pilot regime because it's within CSDR. So, but in the end, it will be probably their job who will be pushing forward the tokenization of markets because one standard, one big liquidity pool, access to the tri-party, all the ancillary servicing we can have via a CSD. Donc, probably it will be that who will be interesting. And as a big bank, basically we are already connected to them. Donc,
And maybe to conclude, I think from the asset manager point of view, we know how to issue tokenized money market fund shares, etc. So what we need is indeed to have the underlyings and also to progress on the cash leg, in addition to what you said.
Yeah, definitely. I think those, and I think what's promising is that all those components are very much kind of coming together and very much at pace as well. And it's great to hear from all of you, I think truly institutional players, on how you're sort of preparing for this new world and all the actions you're taking here. So that's great. Thank you so much for this really delightful panel, and thank you all for sitting through this discussion as well. So thanks a lot.